It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partner and fellow CFP, Kevin Korhorn, and special guest Jared Moxness.
So there are lots of changes that are coming within the new tax laws, the big, beautiful bill, if you will. So the question is, what's staying the same? And with the new tax law changes, what do you need to know about so you can incorporate them into your financial planning? That and more on this episode of the Wise Money Show.
I can't stand the name of every new tax law. All of these laws. All of them. I can't stand it. And I don't like this one either, even though...
Well, the best thing is that this is the OBBBA.
Yeah.
And the Build Back Better law. And so if you said, hey, let's create something that would create just a little confusion, you got it.
I didn't like the Secure Act because that stood for something that the bill was nothing about, like setting every citizen up for retirement. Oh, my goodness. So anyway.
No, there are lots of bills that are, you look at their name and they do the opposite.
They do the opposite. So it just drives me nuts. But what's in it? And really, how is this going to impact your plan? What adjustments do you need to make? We're helping with that right now. If you have a question for the program, we'd love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us engaged that way. Most people do on social media, so wherever you're at, we are there as well. Search The Wise Money Show. By now, you've heard about the new tax law, and here's my guess. You've heard about what's in it. But the reason why I say it that way is this law, unique to all the others that we've had, the Secure Act 1.0, 2.0, CARES Act, all the stimulus, the Build Back Better, all these things. This one is unique in that there has been a ton of hearsay.
Yes.
And you've likely heard a headline, or you've maybe heard someone explain something, and here's the deal. That might not be exactly how it's going to work. And so no tax on overtime, no tax on tips. That's not exactly right. No tax on Social Security, or there's a Social Security tax deduction. That's not exactly right. So not that we are going to set the record straight, but we are going to help clarify a lot of the misconceptions out there. But then also we need to just from the get-go say, now that it's passed into law, it's now got to go to the IRS, and the IRS is actually going to iron out a bunch of details. So there is actually some ambiguity.
That's correct. We're going to see a lot of varying interpretations of the rules, maybe just slight variations, but those are going to get ironed out. The IRS will lay everything out for us, and then we'll have to probably have another show to go about it again.
Yeah.
Yeah, and I would say beware, because I sent the weekend after it passed, there was a great YouTube video, and I sent it to a group of fellow CFPs, and I said, hey, you got to watch this, and can you believe that as starting next year, they took away your ability to, and I'm not even going to tell you because it'd confuse you. And I got someone in the group shot back and said, "Oh, I don't listen to this guy, and here's the reasons why." Well, he was factually incorrect. That video has had hundreds of thousands of views, and it is fake news. It is disinformation.
Yeah, and so that's all over the place. So listen, we're going to go through the biggest changes that are going to impact your plan. We're not going to be able to hit all of them. There's a lot of tax law changes, and we're going to help set the record straight so that you can plan ahead appropriately. Jared, let's start with the big things. Mm-hmm. Okay, let's start with what's staying the same and what's changing. What are the big things? Where should we start, Jared?
Yeah, so we kind of have to go back a little bit to what the tax rules were before the Tax Cuts and Jobs Act, pre-2017, 2018. And really what the TCJA...
Oh, gosh, can't stand that one either.
I know. But what it did was it shrunk tax brackets. So now everybody is paying 1% to 4% less per tax bracket. Now, the biggest change, in my opinion, is that gets extended, and it gets extended what we call permanently.
Yeah.
Now, that permanently is tax speak because it's just until somebody comes along and changes the rule. So the 10, 12, 22, and so on, those tax brackets are staying the same.
And that's a big deal, right? Because that was going to go back to 10, 15, 25, 28, and so on. And even though those might not sound like big numbers, percentages on any numbers make up more tax. And so the fact that those tax rates are staying 10, 12, 22, 24, and so on, yeah, that's a big deal.
That's right.
And I know we're not supposed to say everything that we're thinking, but you're right. They did make a number of these things permanent, but a number of these things aren't permanent. So this is where, as you're exploring and trying to understand, you do want to understand what pieces and parts have become permanent and what pieces and parts are done in 2028 or 2029.
Correct. Some of the other ones are we've seen expanded standard deductions. So now, if you're married filing joint, going into this year, we said, okay, you're going to get a $30,000 standard deduction. Well, that has now increased for this year to $31,500.
That's crazy. I mean, not a big change, but here we are saying, well, this is the rule for 2025, and yes, they made this larger standard deduction permanent. That was supposed to sunset, but then they actually tweaked the standard deduction for this year, even though we all entered the year thinking, or for the past 6 months, have been thinking it's going to be one thing. Same thing with those tax rates are staying the same, but the tax brackets, they're also expanding a little bit from what was released at the end of 2024 for 2025. Those brackets are now a little bit bigger.
That's correct. Yeah. So we're seeing the three lowest tax brackets, so the 10, the 12, and the 22% tax bracket, are all getting what has been labeled an extra year of inflation adjustment. And so what that means is there's just going to be more dollars that land in that bracket. We don't know exactly what that's going to be just yet, but there will be more dollars that land in those lower tax brackets.
Yep. Okay. What else is not changing, but maybe slightly changing? What are the other things that are made permanent?
Yep. So if you remember pre the Tax Cuts and Jobs Act, again, you used to have a standard deduction plus you would get personal exemptions. Those exemptions are going away. So that's not really a change from what you've seen over the last 8 years or so, but that is a change that we're not reverting back to that, and that has been made permanent, so you will not any longer get that personal exemption.
Yep.
Some additional ones, the qualified business income deduction. Now, to avoid getting into too much of the jargon, this is a deduction available for small business owners. That has been extended as well and made permanent as well. Huge benefit for those that own partnerships and S-corps
or rental real estate. And there was talk about changing that percentage staying the same.
Staying the same, 20%.
Yeah, they were talking about moving that to 22 or something
23.
Yeah, 23.
Yep.
Yeah. All right, and then child tax credit. This is something that's also staying the same but changing. So you might not remember this because it's changed so many times, but the child tax credit was $1,000 way back when. It was then moved to $2,000 in the Tax Cut and Jobs Act. It was then moved to $3,600 during, I think, one of the stimulus packages, maybe the CARES Act, but only if the child was below age 6 or age 6 and under. Then it was $3,000 if it was age 6 to 18, but then it got moved back to $2,000. And I'm saying all of this, you can't follow it. I'm saying all of it just to show how ridiculous this journey has been.
Yeah.
These larger child tax credits have been made permanent, but it's not $2,000. They actually tweaked it again.
Yeah, it's going to be $2,200 starting with 2025.
Okay.
And kind of a nice additional benefit is that it is finally going to be adjusted for inflation. And so every year as life gets more expensive, you're going to get a little bit more of a tax credit for your children under age 17 to help offset your income tax.
So already, guys, So those are all the things, not all the things, but a lot of the main things that are staying the same. And already you can see they're a little bit different than the way they were. And here we are in mid-July. And you've already gone through half the year planning and assuming this year was going to look one way, and already you can see now you might get a little bit more credit. Your deduction might be a little bit higher. Your tax brackets in the lowest levels might be a little bit bigger. This is going to impact your planning for this year. That could mean I could do some more Roth conversions. Maybe you were ruling out Roth conversions, and now you need to roll them back in or maybe make some adjustments to your tax withholding. So already we haven't even gotten to the big stuff, Although, Jared, I think you said it really well when you were helping to kind of share a lot of these changes with our advisors. You said that a client said, "Oh, it doesn't seem like there's some big changes."
Yeah.
We're going to get into some, by the way.
Yeah.
But you said, well, the big change is all the stuff that was supposed to go away, but is now
That's
staying
staying the same.
permanent.
Yep.
Yeah, staying the same. So that's just the first little bit. What are those big changes? Well, we're going to get into those and how it's going to impact your planning for this year and the years to come. We've got that more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning. Also on podcast at the same time, but also on a couple local radio stations to us in northern Indiana, southern Michigan, which is why the content's broken up the way that it is, where we've got segments and breaks. This is a break right now that we're on, a radio break. So, but if this content long form is not your speed and you want something more direct, or maybe some of the new tax laws that we're going to talk about, oh, I wish I just had something concise talking about all the details related to that. Good news, we've got that right here on this channel as well. Next Wise Step videos that air all throughout the work week. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, we appreciate it. All right.
Jared, I would pull that mic
Even closer.
I think you can tell because I told you, and then you were talking like this, and you're like, I'm talking into it. And then you went like this, and you could hear the difference.
A little bit.
Yeah. That's why the headphones, it's not to look cool, even though, I mean, you do. It's actually like, is my voice coming through the microphone appropriately? Yeah.
Okay.
All righty. Here we go. Segment 2, talking about salt. I don't know how much of the segment salt will take. It's obviously a big one, so we can meander on a little bit.
Can I give you just some high-level planning stuff on this? This is where you have to be careful with realizing avoidable income. Roth conversions, capital gains that are avoidable, that take you into this phase out can be.
Okay, hang on. Hang on. Sorry, guys. We're on break, right?
Yep.
Okay. I am parenting.
Good. So realizing avoidable income, which said another way,
You got to do tax planning. Your investment advisor and your tax preparer have to be talking to each other.
yeah.
Because the effective tax rate of getting through this phase out for the SALT deduction is 45%.
So really, who you're talking to is someone who thinks they might land somewhere between 400 and 700 of income.
That's correct.
Yeah.
That's correct.
Yeah. Yeah. Dude, it's all right. It's all good.
Yeah. So that's fun.
Yeah.
I might really. One of the kids is getting in huge trouble. Not going to mention which one.
Well, I don't know how to tell you this, but all my kids got in huge trouble.
My kids get me in trouble.
This, I mean, is the SALT, is that a whole, is that the next segment? Like the whole segment?
I don't
it
know.
is-
If it is, we are probably going to run out of real estate.
Yeah.
But we definitely need to camp on this one for a little bit.
If it's not, I would add the charitable donations because they both hit Schedule A.
Okay. Yeah, that sounds good. All right, here we go. New tax laws, tons of changes, little tweaks, and then some big changes. But listen, all of it needs to impact your financial planning, your decisions for this year and for next year. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn, special guest, CFP CPA, Jared Moxness. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Breaking down, doing a flyover, if you will, of the biggest changes within the new tax law, because a lot of them need to impact your planning right now. They're going to influence 2025, you're already halfway through the year. It's going to impact some of your tax decisions right now. If there was like a competition, what's the biggest change? It would probably be the SALT cap deduction. Jared, what in the world? I didn't even know they taxed salt. What is this? Let's level set and then what the change is.
Yep. So the current rule has been that if you were itemizing your deductions, okay, so if you're not taking the $31,500 standard deduction that we talked about, or the $15,750 if you're single, and you are itemizing your deductions, this state and local tax deduction used to be capped at $10,000 a year maximum. That was the most that you could deduct. Yep. Well, starting in 2025, so it is retroactive to the beginning of this year, that deduction goes from $10,000 to $40,000. Okay, that's not an automatic. You don't automatically get $40,000. You actually have to pay the state and local tax or pay the real estate tax to get you there.
Yep.
But once you're there, that's a pretty meaningful change because you live in a high real estate tax state. Yep. I hail from Illinois, and it's not uncommon for Illinois property taxes to be $10,000, $20,000 plus $1,000. And so some of these states, this is a huge benefit to the constituents, and there are a lot of nuances and rules that we're going to need to get into here, but just know that deduction goes from $10,000 to $40,000.
But that's probably the headline you heard. But there's a gotcha.
There is a gotcha.
Yeah, but and to me, the headline behind the headline that should be overarching over all the headlines is that if you used to itemize and then you stopped doing it because of the SALT, and I love to say SALT tax, even though you shouldn't, because of that limit, you probably need to adjust your operating system and make sure you're tracking all the things for your itemized deductions again, because you likely will go back to itemizing.
Well, that's another thing that's made permanent. We got rid of miscellaneous itemized deductions back several years ago, and those are still gone. So, okay, so what's the gotcha in this? Because I think a lot of people just heard the headline. Well, they were squabbling about, is it going to be a 30 limit? Is it going to stay at 10? Is it going to go to 50? Oh, it went to 40. Okay, we're good. Not really.
Not really. So there's a phase out. And so if your income, your adjusted gross income, which the easiest way to think about that is it's your total income. So you add up all your income. There might be a few deductions that get you to your AGI, adjusted gross income. But what's happening is once your AGI hits $500,000, if you're married filing joint or anything but married filing separate. If you're married filing separate, it's actually $250,000, but $500,000. If your AGI hits that amount, you start to get phased out of that $40,000 deduction, and it can go back down to the $10,000. Now, the $10,000 is the minimum. You won't go below that. It's not going to go to zero, but you could lose out on potentially $30,000 of deduction.
Well, and here's the. Okay, I don't want to make this connection, but you probably will in your mind. Folks that are paying high state taxes, it's likely because they have high income.
Right.
People that are paying high property taxes, it's likely because they have high income and are able to afford a property that has higher property taxes or not. And so this is this is going to limit a lot of people.
Yeah. That phase out, it's between $500,000 and $600,000.
Yeah.
So it's basically 30% of every dollar above 500. That's where the phase out starts to happen. And so if you think about it, you could go from $500,000 of income to $600,000 of gross income. So your gross income increases by $100,000. Your taxable income just increased by $130,000.
Yeah, that's wild. And then there's another gotcha as well, that this isn't, and I know you already said permanent is only permanent until someone else changes it.
Yep.
Okay, but this is not permanent. There's a scheduled end date to this where it's going to go back to the 10,000.
That's correct. So
it's going to go back to 10 and then to 5.
No, the 5,000 if you're married filing separate.
Yeah.
That's what I was saying.
Yeah. So that is effective as of the beginning of the 2030 tax year. So from 2025 through 2029 is when this $40,000 SALT deduction applies, and then it'll drop back to the $10,000 max in 2030.
Yep. So you said earlier, Jared, when we were talking about this, and it's going to apply to so many of these tax law changes, you really need to be careful about your avoidable income.
Right.
So explain what that means.
Yeah. So what I mean by that is every year you have the ability to decide how much you pay in taxes. There are planning opportunities that we use all day, every day with a bunch of our clients to decide, are we doing Roth conversions this year?
Yep.
Or should we sell some of that highly appreciated stock because it's making up too much of your portfolio? Those are theoretically avoidable incomes.
Mm-hmm.
And in this case, avoiding those avoidable incomes might be helpful if you're going to find yourself somewhere between, really, if you think your income is going to be somewhere between $400,000 and $700,000 for the year, you really need to be talking, your investment advisor and your tax preparer need to be in sync to make sure that you're not going to find yourself in a gotcha.
So we are just about to start the 11th season of the Wise Money Show. And back 11 years ago, Kevin, could you have predicted that we would be talking about this many tax law changes?
No,
I wouldn't have. And yet, that is why the entire show started. That's why Korhorn Financial Group started 31 years ago, is because these nuances within the tax code should influence the financial decisions that you make. And you might say, well, I've got goals and I want to retire or buy a house or pay off debt or help the kids with college or transition, build an inheritance and transition it, leave a legacy to my family. Yep, and pursue all of those things, but being aware of how those goals impact the 6 areas of your financial life, tax planning being one of them. So yes, you need a certified financial planner. Make sure that they're doing comprehensive financial planning and that you're getting the proactive tax planning work. It just became even more important with these new tax laws.
And I would say it just became even more important that you're working with a multidisciplinary firm.
Yes.
Who has CPAs on their team. We have 2 Jareds that are both CFPs and CPAs, but we've got a number of professionals that can look at not only your financial plan, but your tax plan and say, how do we optimize this? And really the thing that I'm pointing out to most folks is, how do you change your operating system of your entire financial life based on this?
Okay, so while we're talking about SALT, that's part of itemized deductions.
That's correct.
We've already said what's staying the same is the larger standard deduction. In fact, it's getting a little bigger this year than what we were even originally told. But Kevin said, if you're close, if you used to itemize and no longer do, make sure that you run the miles. I mean, for all of our clients, whether you itemize or not, we're going to fill out your Schedule A and do the math. We've told you that's one of the best practices you need to be doing. But charitable deductions, those are changing as well. Charitable deductions is also something that you get on your itemized deductions, but there's also a new carve out, but there's also a new limit within itemized deductions. Can you explain that, Jared?
Yep, absolutely. So we'll start with the deduction for non-itemizers. So what I mean by that is you don't have to itemize your deductions to get a benefit for the charitable donations that you make. Now, this isn't effective until next year. So, 2025 it's not going to help for that. For 2026, it is effective. So if you take the standard deduction, but you still give to charity, you give to your church, wherever, you have the ability now to take a deduction up to $2,000 if you're filing a joint tax return and $1,000 if you're not. Now, this isn't new either. We had a very similar provision during the COVID years and everything. And so it's just a little bit more expanded. It's a little bit bigger deduction, but it is also permanent.
Okay,
so
I was just
from 2026 going forward, this will be a deduction that'll be available until it's not.
So there again, like Kevin said your operating mode or mode of operation. If you've been thinking, nope, I'm not going to itemize. Nope, the charitable deductions, I'm going to stop entering those in, or I'm going to stop tracking those receipts. No, you now need to do so again. Yep. Not for 2025, unless you're going to itemize, due to the new SALT limits here, but definitely in 2026 and beyond. Even if you say, even with the SALT cap change, I'm still not itemizing, you're going to want to be tracking these charitable donations and charitable contributions. That's not the only charitable deduction change. We've got to hit others as well as some other big headline changes. That more coming up on the Wise Money Show with Korhorn Financial Group. Okay, now that my blood pressure's calmed down a little bit. So we've got 3 tournaments out of town, one for each of the kids. And they all start during the week. All of them.
Ouch.
I don't even.
That's convenient.
Okay, so here, feel free to make a comment here. The family that is taking our youngest child, right, who's the one that we should be the most careful of, I don't even know her name.
Listen, I have the conversation with my kids that you don't talk to strangers.
I know. So if the
She just came and picked my youngest son up, and no adult was at home. The closest thing to an adult was the middle child, and he didn't even wake up to help.
Did he sign off? Did he sign the release?
Did you put an air tag in Easton's shoes?
No. And so he's going to be with these folks all day and around a bunch of other people that we've been doing life with. But
That's fun.
yeah, like, so the anger about the middle child not getting up and helping and basically ignoring his alarm or turning it off. I told you it'd calm down. I actually, even just saying it, it's spiking right back up. So, takes a village. Takes a village. All right, so let's quickly hit the charitable floor, if you will.
Yeah. Do you want to hit the itemized deduction?
The only
max?
the only thing
35%?
that
Yeah, but it's got to be quick,
Yeah,
because
I can do it.
if we don't hit the no tax on tips, no
Correct.
tax on
That's
all that.
That's a
okay, the
waste.
only thing that I think has to be said is if you are a small business owner and you're phased out,
The pass-through entity tax.
you have to be doing the pass-through entity tax.
All right,
Yep.
but there's four big things that everyone's heard in the headlines, and we're starting the second half of the show and we haven't talked about them yet. We have to get to those.
We're creating our own headlines. Make it be.
Okay, here we go. Yep. All right. No tax on tips, no tax on overtime, no tax on Social Security. You've heard all these. You can deduct auto loan interest. You've heard all of these things. And while I would love it if that was all true and it made taxes simpler, none of those statements is accurate. That's what you've heard. You've probably seen headlines. None of those statements is completely accurate. There's nuances to each of them, and it works differently than what it sounds. How does it work? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn, special guest Jared Moxon. Every episode of the Wise Money Show is on podcast, wherever you listen to podcasts. Search the Wise Money Show. Subscribe to it there. Follow us there. Rate the program there as well. We appreciate it. Before we get into those big headlines that you've all heard about, we've been hearing about them for 2 years. Campaign trail, then to the start of this administration, and now the bantering around these new tax laws and the different bills that were squabbled about. It's all wrong. That's not right. But we're going to set the record straight. Before we get into it, we left off on some of the itemized deduction changes, charitable deduction changes. Let's really quick hit the other things that you need to know.
Yep. So we just talked about the one for non-itemizers, the charitable deduction for non-itemizers. If you are itemizing deductions, starting in 2026, there is going to be what we call a floor. Now, what that means is the first 0.5% of your charitable donations are not deductible. So and what I mean by that, it's based off of your income. So if your income's $100,000 and you give $1,000 to a local charity, the first $500 is not actually deductible. And so you have to get over this 0.5% threshold, and then beyond that, you're able to take a deduction.
If you are watching and listening on your phone right now and you just had that kind of feeling of, I should just throw my phone, I'm so frustrated, I get you. I hear you. And the tax laws are so complicated. So yes, that's the thing starting 2026.
Yep.
Okay.
That's right. Just one real quick other itemized deduction change is that if you are in the highest tax bracket, so you're paying 37%, there is a rule that the maximum deduction that you can get for itemizing is 35%.
Yeah. So I don't even know how you make sense of that. But yes, good public service announcement. And then the other, Kevin, if you're a small business owner,
You have to be looking at the PTET, the pass-through entity tax. So if you're a small business owner and your income is north of $600, you didn't get the benefit of the increased SALT limit. And so make sure, And just as a best practice, you're working with your CFP and your CPA to get your state taxes paid by the S corp.
Okay.
So
Or
All right.
partnership.
The
a partnership.
the big four, if you will. The SALT limit has been discussed for a long time, but the big four on the campaign trail: no tax on tips, no tax on overtime, no tax on Social Security, and we're going to give you a deduction on your auto loan interest. Again, none of those is exactly true. Let's hit it in that order and how this impacts your planning. No tax on tips.
Yeah. So no tax on tips. What it really is no income tax on some tips.
Yes.
So there is a limit
For
again.
some people.
For some people.
You're right.
That's right. If you are married filing a separate tax return, you get nothing.
If you are working in a job where you receive tips, but it's not predominantly a tip-based industry, you're not part of this deduction.
Yeah, within 90 days of the bill being passed, the IRS or the Treasury Department is set to release a list of basically occupations that would customarily receive tips, and those will be the ones, that'll be the guidance we have to go off to say, yep, you get the deduction, you do not get the deduction.
So you can ignore that email that I sent out saying all financial planners are going to be paid via tips.
Yeah, and doctors and attorneys.
That's right. So no. But it's not no tax on. Jared, you set the record straight. The maximum deduction, though, the maximum amount of tips that you can deduct is how much?
$25,000.
Okay.
So, and this deduction will be something that you do not have to itemize to get. It will be a deduction also that likely does not reduce your adjusted gross income. Yeah. So similar to your standard deduction or your current itemized deductions, if you're a business owner, qualified business income deduction, it is not actually going to reduce your AGI, which,
yeah,
go ahead.
Here's what it sounded like on the campaign trail. Here's what it sounded like on the headlines, even as the law was passed, is there was basically just going to be this carve out on your tax, on your W-2, if you will, or your tax forms, where tips won't even show up. No, they will. So this is where you said no, not like some tax. So it's federal income tax. This is likely still going to be landing on your state taxes, especially because we don't know where the deduction is going to be. It's likely going to be after your standard or itemized deduction. Yep. So you'll likely still pay state tax on it, and you're also still going to pay self-employment tax or payroll taxes.
That's correct.
Yeah.
That's exactly right. And so that's where the planning comes into play. Like, you have to understand that, hey, there might be, if I'm an employee of, it could be a restaurant, theoretically is likely a place that might get this deduction. You have to say, okay, I might not pay the income tax, but I still got 7.65% in Medicare and Social Security tax that are going to be assessed on this income.
So phase out begins at $300,000 married filing jointly. So if you've got primary breadwinner and then a part-time job where primary breadwinner, high income, part-time job is tip-based industry, you might be phased out. And then this is not permanent. It starts this year, 2025, but it goes through 2028.
Yeah, you're going to see that theme with the big four that we're talking about here. None of them are permanent.
No tax on overtime. Heard that one a ton, guys. I have no idea how they are going to pull this off. But again, it's not no tax on overtime. Go ahead, Jared.
Yeah, so this is, again, no income tax on some overtime. So
no federal income tax.
No federal income tax. Yeah,
that's on some overtime. It's only up to $12,500 per person.
Per person. That's exactly right. And when you think of overtime, there is a specific definition of what that overtime is. It's not just, hey, I worked more than 40 hours, and so whatever I got paid over that 40 hours, it's the if you think of overtime as time and a half, it's the half.
It's the
premium. So it's the 50% premium that you're getting paid. Now, how this is going to look, it's likely and expected that there will be some codes or something listed on your W-2 that make it clear, hopefully, for your tax preparer to help carve this out. But as you're doing your tax planning and looking through your pay stub, a lot of times they don't separate out the overtime at your regular rate and the overtime at the 50%. And so you're gonna have to do some math and figure out, okay, how much of my overtime is actually subject to this $12,500 deduction.
And listen, good news, payroll departments and folks that create payroll software, you only have to figure this out immediately because it starts in 2025. Yep. So you've got to have those W-2s correct. Starts in 2025. This is not permanent. Also is done at the end of 2028. But then we also said you're still paying payroll tax on this, and you're likely still paying your state taxes on this as well. So that's the big asterisk in the no tax on overtime, no tax on tips. They tried to say no tax on Social Security, and we could spend, and we have spent an entire show talking about this, because tax on Social Security, we just cannot stand it. It's after-tax money already. You get it back. We just are frustrated with the formula, blah, blah, blah. But what's been passed is actually not connected to Social Security at all. And what we all received in an email from the Social Security Department makes it sound like it is, and that there are some winners and losers. No, what's actually passed is a new senior deduction. How's it work?
Yeah, so you don't actually have to collect Social Security to get the deduction. Okay, the qualifications, if you will, is that you just have to be over age 65, and there is an extra $6,000 per person available. So $12,000 total if you're married filing a joint tax return. This would be in addition to your standard deduction, and likely in addition to the over 65 additional standard deduction that you get. Okay, we think this will probably show up on the tax return similar to how the no tax on tips and no tax on overtime do, but there is an income limit. So if you're filing a joint tax return and your income is over $150,000, you start to get phased out of this. $75,000 for all other filing statuses.
And this is one where I think, again, how does this impact your planning? If you're doing Roth conversions, or if you're harvesting some income, harvesting some gains, if you're on Social Security, you might also be on Medicare. And you might also be looking at IRMA and doing some IRMA planning. If you're doing IRMA planning and want your income to do Roth conversions or whatever, have your income go right below that IRMA threshold, well, guess what? You're going to get phased out of some of this deduction, because $150,000 married filing jointly is well below $50,000 and change below that IRMA deduction or that IRMA threshold, and therefore there's more proactive planning you need to be aware of when you're doing your overall tax planning. So no tax on overtime, or no tax on Social Security, not exactly the way it sounds. We got more coming up here on the Wise Money Show with Korhorn Financial Group.
Okay. Do you think anyone's still with us?
Yes.
Yeah.
Yes.
Okay.
Do you not?
No, I actually. Here's where you lost me. You lost me on the whole itemized, and so I was just trying to.
That was the first segment.
No, I know.
I'm just kidding.
Well, that's what I'm saying. No, the new reduction mechanism, that itemized deductions, including charitable contributions, are reduced by 5/37 of the lesser of the SALT taxes or taxable income exceeding the 37% tax bracket threshold. This effectively
237s.
This effectively imposes an additional 5% tax on certain income, indirectly limiting the benefit of charitable deductions for high earners. Like what does that? I just want to go take a nap.
Mm-hmm.
Like
Yes.
or do, like, the pleasure sensor in my brain is saying, please go do something that makes us happy because we're not happy.
Yeah. But so again, this increases the need for planning. Proactive planning.
Yes.
All right. So fourth segment, land and plane. We're going to hit the auto loan interest deduction and how that's not exactly what it turned out to be. And then we can hit anything else.
I think we should hit the EV and residential energy credits.
Yep. And then, so we'll just see where this takes us, but we'll
For sure, the
popcorn.
EV, just because, and because the time sensitive. Yep. Love it.
All right. Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn, special guest CFP CPA Jared Moxness. Every episode of the Wise Money Show, as well as a lot of other content, is on the Wise Money YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it there. Turn on notifications there as well. During the commercial break right there, Kevin was just saying, you think anyone's still hanging with us? I think so. All of these tax laws matter to you, but there's so many details. There's so much you need to wrap your mind around. We've got a lot of content on the Wise Money YouTube channel devoted directly to just one of these changes or a couple of these changes, and really help you know, well, what adjustments do you need to make in your planning. All of that, though, guys, and even this show is no substitute for your one-on-one work with your certified financial planner. This is tax planning. The proactive work is what you need to be doing all throughout the year with your CFP. And now with these tax law changes, it's needed even more. So make sure you're working with your CFP. No tax on overtime, no tax on tips, no tax on Social Security. We've cleared the air on those. You now get to deduct your auto loan interest. Not really. So Jared, explain how that one works as well.
Yeah, so this one starts this year, 2025. It is not permanent. So like the no tax on tips and overtime and the senior deduction, we'll call it, there is an end date to it, and that's at the end of 2028. But what this is you are now eligible, if you qualify and if your car qualifies, to take an up to $10,000 deduction for the interest that you pay on your car loan.
Not the payment you make on your car loan. Right? It's just the interest.
Just the interest.
Right. So we did the math, or Jared and Kevin were doing the math on, well, how big of a car loan do you need to get to have $10,000 of interest per year? And that would be a massive car loan. The car might be able to fly, actually. So
there you go.
It'd be that expensive.
Yeah. So some of the other things to keep in mind with this is it only applies to new cars, and the final assembly of that vehicle has to happen within the United States. So if you buy an electric vehicle from overseas and they ship it over here and it's ready to go, sorry, no deduction for you on that one.
Yeah.
Yeah, that could be the Toyota RAV4 or the Chevrolet Silverado. I mean, I would go down to the dealership and just install something and say, hey, look, we finished in the U.S.
All right, so it's got to be new vehicles, not used. Got to be final assembly in the U.S. Starts this year, but is gone after 2028. It's only on the interest, max of $10,000. What I don't think we hit is there's an income limit as well.
Yeah.
So you get phased out if your income's too high, which again, if you're buying brand new vehicles, if you have high auto loans, then you probably do have high income and you might get phased out of some of this.
Yeah, if you're filing a joint tax return, that phase out starts at $200,000, and if you're not filing a joint tax return, any of the other filing statuses, it phases out at $100,000.
So no tax on tips, no tax on Social Security, no tax on overtime, and this auto loan deduction are likely. So again, we mentioned right at the beginning that there's a lot of ambiguity. There's a lot of inconsistency. People will speak very confidently about how these things work, and it's actually wrong. So we're setting the record straight. But there also is a lot of ambiguity. The IRS still needs to come through and interpret what all this means, and there's likely going to be some adjustments made when they come out and do that. And one of that is, well, where are all these deductions going to land? Likely will be below your adjusted gross income, so it won't reduce your AGI, and therefore doing the planning work, being aware of what will reduce your AGI, and having those planning opportunities be at a premium so that you can qualify for more deductions and reduce your state tax and so on. So those are the big four. Let's hit the others as much as we can. Next one, electric vehicles, clean energy credits. There's some big changes and some time sensitivity there.
Yeah. So originally the rules that were put in place by like the Inflation Reduction Act and previous legislation was that these would last through like 2032.
Why'd you bring up the Inflation Reduction Act? We already talked about how all these names tend to do the opposite.
I
So
know.
big, beautiful
I apologize
bill.
for that one. No, so those are supposed to last through 2032. But now, if you're going to buy an electric vehicle and you want to get a tax credit for it, you're going to have to buy it before September 30th of this year, because anything purchased after September 30th of this year does not qualify for the credit anymore. That $7,500 credit for new cars, $4,000 for certain used electric vehicles, those are done.
Oh, my goodness. Okay. What else within the clean energy stuff?
Yeah, so many of you have been used to getting a deduction for, hey, I put in new energy efficient windows, or we just replaced our furnace, or we replaced our hot water heater. Those are going away at the end of the year.
Okay, so that one, while that's irritating, that one has driven a lot of tax planners and CPAs crazy because you only get a maximum amount of credit over your lifetime. And so some of the times when new folks would reach out and say, hey, can you guys do my taxes and my tax planning? And we'd say, okay, we need your previous year's taxes. People would say, why? Well, that's one of the things we need to see. Have you already taken some of these credits?
And some of that had changed with legislation last year where some of those lifetime limits were done away with. And so this can be a pretty big deal. So if you know your furnace is 20 plus years old and you know you're going to get one in the next, year or so, it might be an opportunity to get one before the end of the year. But just know that while you've been used to salesmen saying, hey, get these windows, they'll qualify for a tax credit, that's going away. Anything placed in service or put in your house after the end of this year does not qualify.
Yeah. All right. Another controversial one, the Trump accounts. These are new accounts for minors. It can only be opened if the child's under the age of 18. You withdraw dollars after they're age 18. There's no deduction. It's not an IRA for the kid. So you don't get a tax benefit when you put the dollars in. It's just that the growth is sheltered from tax. But then when you withdraw the dollars, the growth is taxable at ordinary income tax rate. So you've got to decide, well, should we even do this? Because the growth is going to be ordinary income tax, which could be a higher tax than the alternative, which would be capital gains taxes. This is only for new babies, right?
Yeah, so it actually applies to everyone under age 18, but babies born between 2025 and 2028 can get $1,000 from the U.S. government to start the account.
Here's the problem. You're not even going to have access to these things for at least a year or more. It's going to take a long time. I mean, we don't even have Roth simple IRAs yet. Or what about the other rule? You can have your company match go into the Roth side of your 401k. I still haven't heard from anyone that businesses have actually built the infrastructure so that you can do that yet. Mm-hmm. So tax laws from several years ago still aren't implemented yet. I think this one's going to take a while to implement as well.
I agree with that. I do think it could be a decent alternative maybe to a 529 plan or an IRA, Roth IRA for a child, but there is so much that we don't know. The IRS is going to have to give us probably hundreds of pages, it feels like, of clarification and guidance on how to handle these. One thing I will point out is if you do have a child that's born between 2025 and 2028, the government says under their pilot program that they will deposit $1,000 into that account to get it started. How that's going to work, I have no idea. I assume it'll be something regarding your tax return and a credit or a refund or something like that. Mm-hmm. It is important to note that these accounts are somewhat regulated, and so you can only invest in certain things. You can't go invest in any mutual fund or any stock or bond that you want. There are specific rules on what you can and can't buy. We'll figure out who applies, but it's going to be for people under the age of 18.
And then where do you open these accounts? Can that be done at Fidelity or Schwab? Likely it will be at a direct government website. We'll see. 529, you mentioned there's some expansion in how you can use 529 plans, but we're not going to hit that. Let's talk about some of the business tax law changes. I mean, there's a flurry of them, but just a couple of the big ones.
Yeah, a couple of the big ones. It's really expanding depreciation. So if you buy equipment, how you can write that off. So for business owners out there, if you're familiar with Section 179, that means you can take the equipment that you'd purchased and write the entire thing off in that year. So if you buy a $10,000 piece of equipment, you can take $10,000 off of your income for that year instead of having to spread it out over a period of time. That limit for Section 179 has gone from $1 million a year to $2.5 million. So now you can deduct $2.5 million per year. And the phase out is beginning at once you start accumulating eligible assets above $4 million, that starts to get phased out. So it's a $1 million to $2.5 million change. So it increases quite a bit. The other big one is 100% bonus depreciation. Very similar in form where you can deduct all of the asset that you purchase. However, this one is a little bit interesting because it was getting phased down over the last couple years. Mm-hmm. Now it's back and it's permanent, just like Section 179 is now permanent. But it is only for assets placed in service after January 19th.
Yeah. So big changes to businesses. Make sure you're doing that proactive planning. Also tucked in an extension or an expansion of the estate tax exclusion and estate tax exemption is going to be $15 million starting next year. So that hole has been plugged as well. Lots of planning. You need proactive planning. No way to keep on top of all these rules and how they impact your decisions. You got to work with your certified financial planner. Make sure they're doing comprehensive financial planning, tax planning. Jared, thanks for being on the show. That's all the time we have for today. On behalf of Kevin Corhorn, Jared Moxness, myself, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Corhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Corhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.